Good morning and welcome to this Wednesday, September 15th, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Actually, I said 30 minutes, but I'm going to actually try to start cutting this off a little early. We've had some feedback in the past, not very much, but I know as a trader, I'd probably want to try and get ready for the trading day. I know sometimes the show goes over and goes past 9:30 Eastern, which is after the market opens. So I'm really going to try to cut this off a couple minutes before the market opens. So we'll try to make this a little bit shorter. I can tell you that futures currently, let's see, last time I looked, yeah, right now we got Dow futures up 9 points, S&P up 5.5, NASDAQ up 27. So NASDAQ on a relative basis looking a little bit better. Last time I looked, I think crypto up about 1.5 to 2%, looking at Bitcoin and Ethereum. Some of the materials, gold down $5.80 an ounce, silver down 13 cents, both of those down about a third to a half of 1%. Crude oil this morning up almost 2%. So crude oil back near $72 a barrel. If you recall, that 77, 78 right in there, that range is going to be really important. That's a long-term resistance area on the price of crude oil. So we went back into the mid 60s. Now here we come back into the low 70s again. It'll be interesting to see whether or not oil can make that breakout. If it does, I think that's incredibly bullish for global economic activity and global equities. So we'll continue to watch oil, but right now it is trading up near $72 a barrel. Let me go ahead and start everybody off. I know some of you may be new to Earnings Beats, so let me take you over to earningsbeats.com. Just simply want to point out, if you'd like to learn a little bit more about us and the way we approach the market, the best way to do it, subscribe to our free Earnings Beats Digest newsletter. All it takes is a name, email address, hit that subscribe button. I publish it 3 times a week. Had an article out this morning talking a little bit about Max Pain, which we had a great session last night. That's a once-a-month event that we do with our members. So if you want to, again, start to learn a little bit more about what we do, how we approach the market, I think this would be a great way to do it. No credit card required. You can unsubscribe at any time. I'd love to have you. So again, go over to Earnings Beats, so that's plural, earningsbeats.com, and then just simply scroll down and you'll find the form here that you can fill out to become a subscriber to our free Earnings Beats Digest newsletter. Taking a look at the market from Tuesday, the Dow Jones Industrial Average down almost 300 points, S&P 500 down 26 points, the NASDAQ down 68 points, mid caps down 30 points, small caps 18 points. On a percentage basis, small caps, mid caps down the most. And if you look across now, it looks like we've got the short-term downtrend seriously beginning. Welcome to September, everyone. Here we are. This is the only month of the calendar year since 1950 that where we've seen more downward action than upward action. In other words, September is the only month where we've seen it close lower than it began more often than not. And so this is kind of typical of what we see in September. If there's one thing maybe that's a little different, it's that normally the weakest part of September is the second half of September. And if that's going to be the weakest half this month, it's not going to be a pretty second half, because the first half, you can see we topped pretty much the beginning of September. And we did essentially the same thing last year. We had a really rough start to the beginning of September, if you recall, but there were many more warning signs technically. And actually, I shouldn't even say technically, it was more sentiment. And we're going to talk about sentiment here in just a little bit. But yeah, we had some sentiment issues last year to kick off September. That's not really present this year, but still we have been drifting lower and lower just about every day on the major indices so far in September. Looking at the sectors, every sector was down. 11 sectors, all of them down yesterday. Energy, financials, industrials, materials, those were your 4 biggest laggards in terms of percentages. All 4 of those down more than 1%. Energy was the leader at 1.44%. And that reversal took place right at the 50-day moving average. Near resistance, I'm going to continue to look at about 50.50 as a key area of resistance. Now, some might say, well, we're back above the 20, or yesterday we climbed above the 50. To me, the most important thing is getting back through key price resistance. So 50.50 is going to be the biggest number on this chart in the short term for me. We'll see whether or not we can handle that. Financials were back down after testing their 20-day. You can see this 37.5 area. Should provide some support, but again, it's September. We'll see what happens. If that gets lost, then I'd be looking clearly at some lower prices. Industrials, I talked at the beginning of the month. This is typically a good month for industrials, especially the transports. Not seeing it so far. I don't know if it's going to happen in the second half of the month, but the first half has not been good. History not really helping in that regard. But industrials, you can see, been down multiple days here in the first half of September. And today is the midway point of September, by the way, September 15th. But with industrials dropping 1.2%, you can see that they have now dropped and closed to their lowest level since back in the middle part of July. We got that double bottom in at 99. Seems like we're going to head back down that area to test it. Materials, we've got a double bottom in right now, right near that 83 level. If that fails to hold, we would be below the 50, the 20, below this price support level, the PPO going negative. That certainly would set up a move back down to about the 79 area, which was that low in mid-July as well. Healthcare has been one of the better looking areas, but had a negative divergence, has now gone down, tested that 50-day. And I would watch this price support level around 131.5, 132, close much below that level. And I'm looking down maybe 127.5. Maybe the breakout 129.5, somewhere in that area is where I would be looking for the next move on healthcare. So you can just kind of see, just looking through all these charts, September's already starting to take a little bit of a toll, but we do have some upcoming support areas on a lot of these charts that we should be watching. 10-year Treasury yield. You can see this morning, actually, let me get an update here. We are currently up 1 basis point, 1.29%. After a pretty steep drop yesterday, we went down, I don't know, 7 basis points, something like that. But we are trying to recover back up again. Again, we're just in this sideways consolidation right now on the yield. I don't really see anything. We got the PPO almost squarely on the center line. The 20 and the 50 are almost together. Price action sitting right on top of them. I mean, this is really the poster child almost of going nowhere, having no momentum. So to the upside, let's watch definitely 140. I mean, I would still go up to about 142, 143, but a move through 140 now, we got a triple top there. That would be pretty big. And to the downside, we got this double bottom over here around 113, 114. And I just think we're in this range for now. So, I mean, the good news is interest rates are incredibly low. That's good for the economy. But at this point, money not rotating out of treasuries, that's what would send the yield going up. And that's normally what sends the stock market higher. You wouldn't think that, common sense, you think, well, interest rates, if they're going up, that's bad for the economy. But actually it's not when you're at historic lows. You want folks to be bailing out of bonds. You want to see folks wanting to get out of bonds and into stocks because of the economic activity picking up. And if you don't believe the stock market can outperform 1.29%, I mean, that's your alternative. That's your safety net, 1.29%. Stock market historically has gone up to the tune of almost 9% a year since 1950. So it doesn't really make a whole lot of sense to, to be choosing 1.29%. So I think what we'll eventually see is the economy continue to strengthen, and I believe yields will go higher. But right now, not so much. And when the yields aren't moving higher, that's when the stock market can have some difficulty. We didn't really see it too much over the summer, June, July, while yields were going down. But now that we're going sideways here, you can see the market has been rolling over, struggling a little bit. Let's see, economic news. We got the September Empire State Manufacturing Index out this morning. Expectation was for 18.6, came in at 34.3, pretty high number. I believe last month was somewhere in the 18s. I don't remember where. I want to say 18.3. So I think we were looking for just a slight move higher to 18.6, but 34.3, the actual number that came out this morning. So that was stronger than expected. August industrial production expected out later this morning and expected to rise 0.5%. July rose 0.9%. So still heading in the right direction, but definitely a drop off from July. And then August capacity utilization last month, 76.1%, expected to move up a little bit, 76.4%. All right, let's move on to talking technically. And this is where I want to talk a little bit about sentiment. So maybe it should be talking sentiment instead of talking technically. This is a 20-year chart of the VIX, and it's a weekly chart. So it just kind of gives you a sense. Here with the VIX is truly is like a fear index. When the market goes down and really starts to drop, that's when you see the VIX just take off. And so in 2007, 2009, when we had the financial crisis, I mean, you can see what happened to the VIX. VIX went up to 90, unprecedented level, up to 90. When we went through the pandemic earlier, a year and a half ago, in March, that steep drop, 35% in just what was it, 4 weeks? 85, above 85 on the VIX. So you can see when real severe panic sets in, that's when the VIX takes off. Now, normally we don't see bottoms with that kind of fear, but we do see bottoms form with maybe a little less level of panic in the air. So if you don't know anything else about the VIX, what I would suggest you take a look at is, and I'm going to annotate just to show you, when you get to these highs, just about any high, any one of these peaks for the most part, I mean, you go back here, I don't know, maybe here, not quite as much there. Even some of these other peaks, just about every peak you look at, you're going to see the market either having just topped or in the midst of topping and rolling back down and hitting what should be some new lows, because fear usually marks bottoms. So if you look at where these bottoms are, take this bottom here. This one looks like came just a little bit lower. Actually, I didn't want to do that. But here you've got one that's not quite at the bottom. Actually, this one, drag this over just a little bit. I mean, when we hit this twin peak, and maybe I should just, there we go. So they were like twin peaks, but you can see right down near the bottom, we did have one more low, but for the most part, that was a pretty big a panicked low. Here, we moved right down here to this low. This maybe not quite right on that low, but not far. This right here, close to this low. I mean, hopefully you can kind of see when you're looking at these peaks in the VIX, normally you're getting lows in the market. Now, I'm going to get rid of all this if I can. There we go. All right, so let's get rid of all of that. The one thing I want to just say is during a secular bull market, and I'm going to highlight the secular bull market with a thick black line coming down right here. That's basically when the bull market began. The reason I call that the beginning of the bull market was that is when the S&P 500 right here took out the high from 2007, and you don't see it, but the high from 2000. Until then, you don't know. I mean, you could have said that this was the start of a secular bull market, right? Because you're doing all this, but you never got above the 2000 high, and we went right back down again. So it was a false call. The only way you know for sure is when you actually break to a new high, which occurred right there. Now, when you get into a secular bull market, I can just tell you that from history, you can see anything up in the 20, I'm going to say 25 to 30 range. So right in there is where I think you see most panicked sell-offs come to a conclusion. And so you've got one here, and I can do the vertical line again. So here was one, and you could see when we went up to 30, we literally marked that bottom right there. Here, we actually went up to 45, 50, which is unusual. But right there on that, you can see we marked that low before we bounced up. Here we go back up to 30, mark this low. Here's 25, mark this low. Here's another trip, the 1 to 50. Didn't quite mark this low, but pretty close. Here's a 30 top right at the low. Of course, 90 or 85. You know, and the problem is when you're pulling back and you think, okay, I get to 30 on the VIX, that's where I want to get in. Well, if you got in there, you just been holding during a complete meltdown. So obviously there's risk even when we get back up into 30. Coming back down here, what I call these are aftershocks. I mean, you see the same thing when you come back, you know, when you're coming out of this 90, 85, any kind of, I mean, everybody's still thinking so bearishly that it's easy to panic again. And so I think you get a lot of this back and forth. Same thing here, a lot of this back and forth, but the overall trend is down while the market's going up. Overall trend is down while the market's up. I think the difference here, though, is we had these two twin peaks back here. We were still in the bear market then. So that's why I've kind of got this thick black line kind of offsetting and only looking beyond. So my point here is that while we're in September, if we do sell off, watch for that VIX. If the VIX gets up to about 25, 30, I think we're probably getting close to a very significant bottom. I don't know if we're going to go there. I mean, for all I know, the next 2 weeks we could go higher. Stock market can do whatever it wants to do. But if you're building cash and you see the market continuing to go over and support levels being lost and the VIX rising, right now the VIX is at 19 and change. Trust me, it wouldn't take much selling for the VIX to go up a couple points one day, 3 or 4 the next, another 3 or 4, and we'd be right at 30. So that's what I would be looking for. If you want to be more conservative and if you believe that, hey, September weakness, second half is going to kick in, that would be a time that I would be thinking about reestablishing maybe some positions that you gave up, or if you're trimming positions, you know, making them smaller, maybe you build them back up into weakness in the second half. But that's the VIX. The other one is the equity only put call ratio. And the first thing I want you to do is just look at some of these lows. This is when the market's getting very complacent. The lower this ratio is, the more calls are being traded versus puts. And of course, if more calls are being traded, it's because the market's going up. Everybody thinks market can't go down. And so you might think that these really low readings would mark major tops, but they don't. You know, you can kind of just eyeball it here. This one actually did mark a pretty good top back in 2012. But if you look at these others right here, I mean, for the most part, market just keeps going up. Look at the one here. We dipped down to the lowest level in over 2 years. What happened? We didn't even pause. I mean, we just kept going higher. Now, the one in 2018, I thought worked pretty well. This one, the second one, maybe, you know, right at the top here. But the pandemic to me was like a one-off. I mean, it's a 1 in 100-year pandemic. It's kind of hard to really assign technical indicators to it. I really don't even look much at technical indicators when it comes to something like that. But I want you to look at all of these complacency readings here. And you could point maybe to July, marking this top, and back in maybe June, marking this brief top. But we kept going down and we went below 0.4 a couple of different times, and the market just keeps going up. And so one of the things I've learned over the years is, yes, complacency can mark tops, but don't use that as your primary indicator, because you're going to get out of the market and the market's going to keep going up and you're going to struggle when to get back in. I would be using this as a secondary indicator. So if I have other problems in the market, if I'm seeing negative divergences, some other things, and I know that there's also complacency, then that builds the case for wanting to get out. But I wouldn't solely get out based on low complacency readings. However, on the flip side, once again, panic tends to mark bottoms pretty well. And when everybody starts buying puts, like there's no way we could possibly go any higher, that we're just going to keep going down into oblivion, that's when the market bottoms. So I want you to look at these 0.9 readings. Now, they don't happen very often, but when they do, actually, I'm going to make this a blue reading. But let's go ahead and there's that top. There's that top. There's that top, and here's this top. Now I want you to see how well they mark bottoms. I mean, pretty much we bottom there. Yeah, we had one more slightly lower move, but for the most part, that was a major bottom. Here, major bottom. Here, major bottom. So when you get to that level, that's where you're basically throwing the baby out with the bathwater. Okay, so just keep that in mind. 0.90. Now we're nowhere near that. So fear is not in the air right now. But we've also been in a little different environment. And so sometimes you just go into these ranges. You know, like I'm looking back in this period right in here. And you can kind of see that the ranges were about here. And these were the outliers in this range. Mostly we stayed in this range, and then you can kind of see the outliers. All right, so I'm going to get rid of that. And now it's almost like we're in a new normal coming out of this pandemic. Now this will change, but for now, this has kind of been the new normal. So when you look at it, 0.6 is kind of the new 0.9. Anytime we get up here to this 0.6 level, I mean, I guess I could drag that up a little bit higher. But, you know, when we get up to that 0.59, 0.6 level, and we start marking these right here, pretty close to the bottom, right at the bottom, right at the bottom. So for now, what I would be doing until this range changes is I'd be looking for anything close to 0.6 in this secular bull market advance. I'd look for anything near 0.6. Eventually, we'll get to a different market. I mean, we were just in a crazy market back with the pandemic, and coming out of this, I mean, everything, even though it's a secular bull market, we haven't seen anything like this since we came out of the pandemic from back in, 1918. I mean, I guess a little bit coming out of the 1987 crash and the 2009 financial crisis, but this is not normal secular bull market behavior. This is almost secular bull market advance on steroids. I don't know what to call it, but it's been crazy to the upside with just tons of rotation and insane volatility. But anyway, I just wanted to point this out. From a sentiment perspective, this is what I would be looking for. All right, so let's get rid of that. Let's get rid of this. I wanted to go through and just show you a few industry groups, because yesterday I talked about gambling stocks looking pretty good. And I don't know if you saw gambling stocks yesterday. China came out and said they were going to be changing the rules, making it more restrictive and so forth. And these many of these gambling stocks got absolutely crushed yesterday, and they don't look very good in pre-market this morning either. And so it just goes to show you how quickly the rotation is taking place. I've said it's been insane. That is maybe the poster child for the insanity of what's happened to gambling stocks just the last week or so. But anyhow, let's take a look at some that have been a little bit more reliable. First one I'm going to show you is semiconductors. This is a relative chart, semis versus the S&P 500. So there's one that I think looks pretty solid. And when I'm bringing these up, these are some of the areas that I would prefer trading stocks in. I just feel a little bit more comfortable that I'm not going to get crazy whipsaw like we did with gambling area. Next up would be software. And again, just look at the relative strength. We went through a period, but not a big sell-off on a relative basis, mostly sideways, slightly downward, but now you can see we've broken back out again. Next up is the electronic equipment. Huge move in 2020 into 2021, and pretty much just going along with the S&P 500. Next up, computer hardware. Big move up, sideways consolidation. I think still looks good. In the discretionary area, not a lot. I mean, I got a few here for you that I would certainly keep in mind and kind of watch. Furnishings, been a little weak of late, but I think we're going to turn back higher here, so that's one to watch. Footwear. Footwear has been weak here over the last month, but I think it's going to turn back up again. Still got that relative PPO well above the center line. I would be looking right around these moving averages for it to turn. We'll see. The business training and employment agencies, this has been a pretty steady mover for probably the last year and a half. This one still looks pretty good. And then autos. I think autos continue to look strong. We had the huge move up. It's taking a while. We moved down for 3 or 4 months. I think we're starting to regain our mojo here. with the autos, and Tesla breaking above 700 recently, I thought really helped to ignite the group. In the communication services area, internet, this I'd say has been one of the most consistent areas of the market for the past few years. Internet just continues to lead, looks good. Industrials, I would maybe take a look at something like the heavy construction, which was strong, pulled back, now starting to strengthen again. Transportation services, I think still looks pretty good. Been moving up for about that year and a half on a relative basis. Other areas, let's see, in financials, really like the specialty finance group. See if I can find that one for you. There we go. Specialty finance looking good. And then perhaps in, in the healthcare area, I like what's going on with medical equipment stocks turning back up again. They had a rough 6-month period, but overall you can see that's been a group that trends higher mostly. I think this one looks pretty good. So those are some of the areas that I would maybe take a look at. All right, let's move on to these earnings. I just have one company I wanted to show you. This is Jinko Solar. They reported this morning. They beat on their top line. They beat on their bottom line. They crushed their bottom line. 89 cents was the profit. Wall Street was expecting a loss of 23 cents. This is what I'm talking about with earnings. Some of these beats are just crazy, and it changes valuations. But the stock, even with this huge beat, up about 2.3% pre-market last time I looked. So the problem is not Jinko Solar. The problem has been just renewable energy. And renewable energy has started to move again. If it does move, if it starts to break out again, I think you're going to have a winner here with JKS, but we've got to get the group going. And we'll see what happens there. All right, 3 you must see, and then we're going to wrap this up for today. I'm going to start off with TXG. I'm going to give you a couple that have just been horrible the last day or two. 10 times genomics. And I think this might be one of Kathy Woodstock's over at ARC Funds. And I know it was. I don't know if it still is. I haven't looked at her holdings, but this is a stock that's really gotten beaten up last 2 days. 185 down to 155. Got a little bit of support coming up. If it doesn't hold here, be careful, because next stop would be all the way down closer to 130. And this is, you can see this is a stock that moves very, very quickly, reprices very quickly to the downside. One other thing I'll point out on this chart, look at that false breakout. The high 203 there, high over here just above 200, got up to 208, looked like we had a breakout. When you see those false breakouts like that, that is generally a bearish signal. If I own a stock and I'm thinking I have a breakout at 2 o'clock in the afternoon, and by 4 o'clock it's complete failure. I know sometimes it's hard to sell at 202 when it was just at 208, but you got to look at that resistance point. When you get those false breakouts, you got to be very careful. All right, next up, HLF, another one. I mean, what a day this one had yesterday, down 21%. Look at the volume. Can't make up that kind of volume. It gapped a lot lower, continued trading, broke below multiple support levels. It lost its 20-day. It lost its 50-day. It lost 51 price support, 49 price support, 47 price support. It lost 47 gap support, 45 gap support, and then all this price support, massive price support at 44. Went through all of them like a knife, hot knife through butter, and with that kind of volume. For me, that is a sign you might get a bounce, a temporary bounce, but I'd expect nothing more than a dead cat bounce. I would be out of HLF. I don't like it at all. But let's end on a positive news or positive chart. Tower Semiconductor, TSEM. Here was your breakout above all this resistance. Look at the volume picking up. I think that's a nice breakout there. All right, market opening in about 45 seconds. So I wanted to get it done a little bit earlier. I'll keep working on that. But want to wish everybody a great day. Hopefully we'll see the market try and rebound a little bit from the recent losses. But definitely batten down the hatches because we do have the second half of September coming. Happy trading, everybody.